Hello, in this presentation, we will record the receipt of inventory with a bill into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're going to take a quick look at software like QuickBooks and then jump back to Excel and record this information. If we were to enter this information into QuickBooks, we're going to imagine this process. We're in the vendor section of QuickBooks and we're just seeing the flow process here of the purchase of inventory. Remember that we are purchasing guitars, we're buying and selling guitars. That typical process will be that we'll have a purchase order and then we will receive the inventory and we're going to record the receipt of the inventory with the bill at this point. This is a little bit different than we might think of when we buy something from like Amazon or something. Typically the purchaser, if we're a single individual, does not have the ability or the authority to be able to say, I would like, or the power within the transaction to be able to say, I would like you to ship the goods. And then if I think they're good, I will approve them and I'll send you the check upon receipt of the goods. When we buy something, we typically have to pay for it first, and then we get the goods shipped to us. At this time, if we buy in bulk or if we have this relationship with a vendor, it's often the case where the purchaser might have more purchasing power or more power in that negotiation to be able to say, I'm going to send out a purchase order, a request for inventory. Once I receive the inventory, then I'm going to count it and check it out, and if it meets our standards or it meets our request for the inventory on the purchase order, then we'll go ahead and pay the bill. So that's going to be what we're going to say the process is right here. That means that we already, in this case, sent out the purchase order, and now we are receiving the inventory with the bill. You can imagine the box with the guitar in it and the bills in there that we then have to pay. We didn't record anything for the purchase order in terms of our Excel bookkeeping process because we didn't receive the inventory and we hadn't made a payment. There's no financial transaction. In QuickBooks, we'd still have this process. We would enter this information to process the purchase order. And then when we go to the receive payments, it can then generate that information. So we'd say receive payments. Now we got the inventory, the guitar in the mail, and the bill is in there with the guitar that we received in the mail. Once we enter the vendor, which in this case is Fender, the vendor that we purchased from, we purchased our guitar, in other words, from Fender, that being the vendor. And once we select tab, it says, do you want to open the purchase order if there's a purchase order for this vendor? And that will connect the two. We, of course, don't have that in our Excel problem because there's no financial transaction for the purchase order and won't be able to populate the bill based on the purchase order. But in an accounting system and software, it can typically do that. If it does, then we would just select the purchase order, and then we would have all the information populated in the bill. Notice what the bill looks like. The bills are driving what would be done in most software where we just populate the bill and it does the or whatever form, whatever document, in this case a bill, and it would then use that to create the financial statements and the reports. So we just have the vendor. It looks a lot like a check, of course, except that a check would be decreasing the checking account. A bill means that we're going to be doing something to accounts payable, a liability account. So we got the vendor here, we've got the date, we've got the amount, and then the bill date. And then the important thing down here is we've got the items rather than the expenses. Items for QuickBooks means inventory items. This is what populated automatically when we were just clicking on that purchase order because it pulled over that information from the purchase order, meaning it gave us the inventory item, which is an SQ in this case, a Squire, and we got one of them. $168 would all populate automatically then. It had been assigned to a customer, so we had to enter the customer in to the purchase order, which then populated in the bill here as well, meaning we purchased this guitar specifically for a specific customer in mind, probably one that came into the store and said, I would like this guitar, and we don't have the specific specifications that they would like, so we made an order for that. And then this is the purchase order that we have. We're going to record this in QuickBooks, and of course what we will then have to do is say the bill is going to increase accounts payable, and we're going to say that the other side then will be the fact that we got inventory increasing. The fact that inventory increases then means that we do need to track that inventory as well. We're going to have to include it in our subsidiary ledger. We also have a vendor here that we're going to have to track, say, who we owe money to. So we will have to track that in a subsidiary ledger as well. Back to our Excel problem, we're going to go through this transaction. We had a bill. Remember, we got a bill and we got the inventory. So we are imagining we got the inventory, we got the guitar from the vendor, which happens to be Fender at this point, and we are going to record the inventory as well as the related bill. First question I typically ask, is cash affected? And in this case, we're going to say no. We haven't yet paid it. We got the inventory and we're going to record the fact that we owe money. I would then think about what we received. What we got is inventory. We got another guitar. So we're going to say the inventory then is an asset. We got more of it. Therefore, it should be increasing. We will increase inventory with a debit. So I'm going to copy the inventory, scroll down to the next transaction field we have. It's on A17 and put in the date of 2/14. And we will then put in right click and paste 123 inventory. We're then going to put the amount, which was 168. 168 is the amount that we actually paid for the inventory. We will then credit something for 168 and put a negative of that number. So we're just going to say negative of that number, or we could just put in a negative 168 as well. And we didn't pay cash, of course. Cash didn't go out. Checking account didn't go out. We paid by giving an IOU. We owe them money. That is accounts payable. So it's a liability representing the fact that we owe something in the future for something that happened in the past. This thing happening in the past being the purchase of a guitar. And we know that it's easier to think of what we received first, because it's easier to know what the asset's doing. It's going up. Whereas if we look at the liability, we may not know whether we debit or credit it unless we've done this for a while. So in any case, we have a liability here. We know we're going to credit it because we debited cash, but if we think through it, we know that liabilities have credit balances. The bad thing is going up. We owe more money. Therefore, we're going to do the same thing to it as its normal balance to increase it, that being the rule, which is a credit. So we're going to copy that amount. Going to put it on the bottom in B18, right click and paste 123. Going to go to the Home tab, do some formatting, go to the Alignment group and increase the indentation. So there is our journal entry. We will still have to record the subsidiary ledgers, but before we do that, we're going to go through the process of posting this journal entry that we just journalized in the general journal to the general ledger. So in order to do that, let's freeze the panes. We're going to scroll up top, put our cursor in AJ1. We will then go to the View tab up top, Windows group. We're going to go to Freeze Panes and select the first item, which is to freeze the panes. Then we'll scroll down. We're looking for inventory. That's going to be the third account on the trial balance and therefore the third account on the general ledger. Scrolling over to that third account, we see accounts receivable. I'm assuming it's going to be under the accounts receivable. If I'm right, then that would be good. There it is. It's inventory. It's in AQ. We are in cell AQ24. AQ24 equals, we're going to point to C17. C17, it's right there. C17, enter. And that puts the 168, which increases the balance of 1,945 by 168 to 2,113. That then can be found in the trial balance. Scrolling up, there it is, 2,113. Scrolling down, we then want to post the accounts payable. First time I believe we've done that so far. Here's accounts payable. It's going to be the first liability account, so we're going to look for that first orange account. First orange account on the trial balance means also the first orange account on the general ledger. It's in order. Green accounts assets, orange accounts liabilities. There's the one we want. It's in cell AZ15. So we're in AZ15 equals, and then we're going to point to that 168, bringing the balance to 168. That balance then should be found on the trial balance as well. So here we have the trial balance, and there's the 168. Now we're going to scroll over and post the same information to the subsidiary accounts. Remember that the accounts payable represents who we owe money to. In other words, this means we owe money to people. vendors is what we call those people typically who we owe money to in terms of accounts payable. And we also want to know more detail about that. We could get more detail from the general ledger as we can from every account, but it only gives us detail by date of transaction, and we want to get detail by who we owe, who the vendors are that we owe. So we're going to scroll all the way over as we have with the accounts receivable account and make a subsidiary ledger and really just post that same information. It's kind of like another GL, but it's in order by vendor rather than just by date. Here we are. So here is, we're going to have a new one right here. We're going to say this is a new vendor named Fender, who we buy guitars from. Fender's our new vendor that we buy guitars from. And we're going to say that that's a credit. So I'm going to post that same credit over here in the credit side in DE7. We're going to say that that equals the 168, and that'll increase the credit balance to 168. Then if we look at our total here, we're at 168. That should match what's on the trial balance. So let's go all the way back to the trial balance and just double check that really quickly. So we're going to scroll all the way back to the trial balance. We see it there on the general ledger, 168. That's a good sign because that's what the trial balance is built from. And there's the 168 there. We need to do the same thing for the inventory. The inventory is here. It's in number. It's in dollar amount. But we know that inventory is actually guitars. So we need to back up this dollar amount with guitars and value those guitars with dollars somehow. So let's scroll over to our subsidiary type account for guitars. And we see this information here. We're labeling each guitar and tracking each guitar. We have an SQ guitar. So we're going to scroll all the way down. I believe this is a new guitar type. So we're going to scroll all the way down to the bottom. And here we are. So this is our new area. It's in CE88. We're going to put the date of 2/14. And then remember, we have three columns here. We've got the purchases, the cost, and the inventory. This is where we're going to put the new purchases. This is where we're going to put the cost of goods sold when we sell the guitars. And this is what is remaining. So these two are really the activity happening. This last one is where we are at in terms of the asset at the end of the day. So here we're going to say that we got 1 in terms of quantity. The cost is 168. So I'm going to tab over there and we're going to multiply that out 1 times 168, which will be 168. So we're going to do that with a formula though. So we're going to say equals 1 times 168 and enter. And then we need to pull that same information into ending inventory. So this is really showing the activity, the journal entry. This is showing the ending inventory that is still left. So we're just going to say equals. I'm just going to use formulas again and say this equals that 1. This equals the 168. And then I'll multiply that out one more time. Equals 1 times 168. Then remember, we need to update this last formula as well because it's a kind of a static formula that we have to update each time. It's not a fancy formula that's going to update. So it's a nice simple formula. So it's just adding up all the end cells here. And so we added another cell. See, it's adding up all the end cells. We added this item. So we need to add that to our formula. So I'm just going to say plus at the end and point to that last item and enter. So if we were to double click on it now, we could see that it's just adding up all the end cells. If there's a problem with it, just delete it and go through and just add up all the last columns, all the last cells. So we're going to go check now that should add up to 2,112. That's what should be on our inventory items now. So let's go check that. We're going to check inventory on the trial balance. We can actually check it on the financial statements here. So inventory on the 1,000, it's $1 off. That's okay. That's rounding. 2,113, 2,112. If we check the inventory over here, let's check the trial balance. 2,113. So it's $1 off. That's okay. Looks good. Let's tie out our financial statements now. What we did is we did something to the payable, and we did something, of course, to inventory, which we just looked at. And we'll just see how that populates over on the financials and how it just generates automatically as it would in a similar fashion to in accounting software. Before we do that, however, let's unfreeze the panes by going to the View tab up top, Windows Group, Freeze Panes, and unfreeze the panes. Then we're going to scroll all the way to the right. We're going all the way to the right to find this information. Scrolling all the way to the right, we see that inventory has been updated as we think it should be. Accounts payable has as well. We see that total assets still equal total liabilities and equity. Nothing has happened to the income statement because we just purchased inventory. We have not yet sold inventory. When we do, it will be expensed in the form of cost of goods sold, and we will have the related revenue, of course, in the merchandise sales. We then have the statement of owner's equity, which has no change as well, that being no change on the income statement or equity. We still have the loss on the income statement of $346, that part of the statement of equities, part of the calculation of the ending owner's equity balance of $143,829, that amount found as well on the balance sheet.